Okay. Uh, Good evening, everybody on the East Coast. Good afternoon to everybody on the West Coast. This is Option Professor of OptionProfessor.com. And just a quick background. We've been doing this in the market as far as educating people on the uses and risks of options, as well as explaining all the different opinions and observations we have for decades. So we have conducted hundreds and hundreds of seminars, webinars, live and on the net for thousands and thousands of investors. So we obviously have quite a bit of product knowledge and information to share. What I do always start out with is, obviously, I'm giving you my opinion and my observations on all the markets and some of the things that are going on. And we do recommend you consult your brokerage firm to discuss your suitability and risk tolerance for anything. And what we're talking about here is information, and we're not talking about any specific advice. So without further ado, I would like to start going into the markets here. I'm going to cover everything from the stock market, bonds, interest rates, the US dollar, international markets, the energy markets, the metals, and the crypto. So there's quite a bit to cover, and we're going to start out with the S&P 500. In the news, we have basically all-time highs going on right now. We've got a situation where Q3 earnings came in and they blew the cover off the ball in most cases, some not, and the ones that did not certainly are getting punished. You can ask Cisco about that, and this afternoon you can ask Williams, Sonoma, and Workday, because they're getting hit a little bit as well. But you get the idea. If you delivered the goods, you can get a pop out of this stuff. Two cases in point would be Macy's today, up over 20%, best day ever, still has a PE ratio of about 10. And then, of course, you had NVIDIA, which, of course, how could they not be making a ton of money with all the stuff they're into? And their stock popped as well, although a lot of these things are doing a little bit of a fade after they run up. Today, also, Apple made a new all-time high on 2 times normal volume. Some people think that might be something to fade into. We'll have to see. People like it in the high 140s or the low 150s better than right now. We'll have to see. They came out with some information on autonomous cars. I'll get into a company that was affected by that today that is fairly cheap, and you can take a look at the chart when I get there. But before we get started anymore, let's give you some more news going on. We know retail sales was great, way higher than expectations. We also know inflation's running at a 31-year high. We also know online sales are up 4%. Hey, the consumer is flush with cash and they want to spend their money, and that's what they're doing. So that's, again, why the holiday season seems like it's going to be so good. And that's why the GDP forecast for Q4 is very, very high. So we'll have to see exactly how that comes along. With regards to other things that are going on, Ford and GM are certainly much lower valuations, because we did see some of the other companies like Rivian get hit. And we've seen Lucid go through the roof with extremely high valuations. Some people are leaning towards Ford and GM because they figure they're going to get in the EV business, and they're much lower price valuation, and they have very good distribution centers. So they're looking at that kind of thing. Growth versus value, a big thing when you're talking about stocks here. A lot of people don't understand it. There's a ratio between the growth and the value stocks. They had a little dip where value took the lead maybe 90 days ago, 180 days ago. And then lately, in the last 30, 60 days at least, we've seen growth outpace value by a lot. So again, that's where the money's being made: semiconductors, tech, that kind of stuff. Other things that are going on generally in the news, let's see. Well, Tom Lee, the big forecaster guy, him and his technician, I guess, were saying that we could see a high point this week, and we could get a substantial or significant, or let's call it a buyable drop before the December period, where we could rally into the end of the year. So it'll be interesting to see if that's accurate or not. Today it certainly wasn't accurate. We made all-time highs. But the week is the week, and they said this week would be the high point. The high on the S&P so far is 47.24. We went home at 47.04. Excuse me, 47.18. And we went home at 47.04. So we're knocking on the door, but if it turned down tomorrow for whatever reason, and we turn down next week, then maybe Lee and his buddy has got something going on there. With regards to inflation, there is some cracks in the armor on the inflation thing. So, we've got a very big December ahead of us here. On December 10th, they're going to come out with CPI. On December 14th, they're going to come up with PPI. One is the producer price index. The other one is consumer price. They're both going to be out before the Fed meets, which is on 14 and 16 of December. So the Fed's going to have those numbers as they're in that meeting. That could have an effect on that meeting. Now, there is some things talking about that inflation might be abating, because obviously it's the big thing in the news. So once it's in the news, it's probably behind us, right? So here's the deal. You've got the China coal prices down 55% in the last month. You have got oil prices cracking to the downside. And one of the biggest rig companies who own most of the rigs, they're getting nailed. Their stock's gone from like 130 to 90. So, that's a little weird for oil. And then, of course, the Baltic Dry Index, which is running after the shipping rates, they're at a 5-month low. So, as you always have to worry about is, if everyone is on one side of the boat, which is the inflation higher interest rate boat, then the other side of the boat may have some credence. So again, we'll have to see, but those are some of the things that are telling us that maybe the inflation certainly will not keep the pace, and it may have a situation where it could abate. Hey, that bond market still has not taken out 175 on the 10-year, and until it does, all this screaming about high interest rates is really that. It's a lot of talk. You start breaking 175, now you've got some meat on your sandwich. But if we don't break 175 on the 10-year, which was the high yield in March, and if the inflation abates, and if the market were to roll over, I think you might be able to throw out that 2% 10-year that people are bantering about. But right now, all I know is what I know. And I know that the high and the yield in March of 175 and the lows in TLT around 133, they're still intact. And everything else is a conversation. Let's see what else is going on. Yeah, we've noticed a little bit of a tailing off on some of the travel stocks. And that makes us a little concerned about COVID. The other thing that makes us concerned is the chart in Germany, which shows a spike up taking you to about the highest case levels that they've ever had. And they're talking about a lot of restrictive activities in Europe because they're very concerned that we're going to get a pop, because this November timeframe where it's freezing outside and people are inside a lot is when the germ gets spread. And so, one gentleman from Johns Hopkins was saying, he's been involved in the AIDS crisis, and it's a 40-year situation there. So it might be conceivable that this COVID is with us for decades as opposed to weeks and months. That doesn't mean it has to be a problem, but AstraZeneca, which is what Europe used quite a bit of as a vaccine, seems to have an efficacy rate that is, shall we say, less than pristine. So again, a lot of people are still fighting getting the vaccination and all kinds of stuff. So it'll be interesting to see what happens. But, they're fading out of the travel and leisure stocks for a reason right now. So we'll have to see. I'll get into that in a second. I'll show you some charts. Let's see if there's anything else. I was just jobless claims came out today, 268,000. We were looking for 260. So they're a little higher than people were looking. And the prior month was revised upward. Job openings are at all-time highs, but the quit rate is at 3%, which is also a record. So there's a record amount of quitting going on. So again, the jobs market is certainly back down to like the mid fours, 4.5 or 4.8. The lowest it ever was 3.5. So for all intents and purposes, that job's been done. Any jobs that were going to come back seems like they've come back for the lion's share of them. So now that obviously the focus will be on the inflation. And again, they probably don't want to pull the trigger too fast, because if some of this stuff is going to fade quickly, like used car prices or something like that, once the chip thing gets going and we got more cars on the lot, a lot of these companies don't have cars on the lot. So obviously the used cars have had an inordinate jump in price because obviously there's a scarcity. That can change, obviously. Bottlenecks, those people that are out in the ocean there with all their tankers, they're ultimately going to come to shore. So we're ultimately going to get a ton of product. Now, we have pent-up demand, right? Well, pent-up demand is not unlimited demand. So there could be a change in the supply-demand dynamic next year, which obviously makes people more concerned. I'll get into that in a minute as well. Let me see if there's anything else. Yeah, as far as margin profits are concerned, obviously you got two good case in points this week. Walmart and Target did very well on their earnings, but people are very concerned that their margins are shrinking as far as they're getting squeezed by wage costs and other other costs that are pinching into their margins. So you got two good case in points there. If you wanted to get an example of what that means. All right, let's go into some of the markets here now a little bit and give you a little bit more of a close-in view on some things. Okay, this is a long-term graph on the S&P. I like to put this up so people can keep in perspective where we are. This is going back to 2000, right? So here you had a big run up in 2008. That was supposed to be a big bubble, right? And look at the drop it had, right? And then we went on a run. Obviously, this is what QE does. It inflates assets, right? That's what QE is all about, printing money, keeping rates low. People go out and buy things on margin, right? They buy their house with nothing down. They buy their car with nothing down. And so everyone's running around, with a very high lifestyle, right? And the reason they can do it is that the payment on all that stuff is very low because the Fed has kept the interest rates by artificially buying back stuff and things like that, by keeping increasing the money supply to an enormous level. And that's how you get a big run. And that run was going on and on and on. And the only thing that killed it was two things, really: a taper scare where the Fed tried to raise rates. Look what happened there. That's a 25-30% drop in the stock market in 2018. And then, of course, when you close down the whole economy and no one can leave their house, that's going to obviously nail the markets. And that's why when it came down here, the Fed wanted this thing to get back above the blue line as fast as possible. Because once this thing goes down here and then the consumer says, we're not going to spend money like that ever again. If they start talking like that, then our whole system is in big trouble. So what do? They print 90 trillion zillion dollars, whatever they did. And then they, rather than, buying securities from the Fed, because that's illegal, I think, through the Act of 1913, the Federal Reserve Act of 1913. So what they do is they go to Treasury, and Treasury opens up 14 facilities, which is what? 14 different facilities that they can buy junk bonds in and muni bonds in and corporate bonds in, which the Fed is not allowed to do. So the Fed loans the Treasury the money, they put them in these 14 facilities, and now we're back on the bicycle, we're above the blue line here, and now we're back at it. How do you go from here way to heck where we are? You put obviously too much money in the system, and you kept interest rates too low for too long, and that's how you get up here. And this is what the bubble looks. Now, let's go into some other aspects of here on the stock. This is when people are saying people might be underestimating the risk. This is what they're kind of talking about. And you know who's selling up here? Insider selling, according to some sources that I've read, are at all-time highs. So if corporate officers are doing a ton of selling up here, we heard about Musk, he's trying to act like he sold it because of Bernie Sanders. Hey, he might be selling it because he knows competition is coming big time, and it'd be very difficult maybe for Tesla to hold on to this valuation. That might be the true story behind it for all we know. So, and then there are some reports that other chief executives and people like that have been fading into this a little bit. You can't read too much into this. They could have many motivations for doing it. But again, some people do look at it, insider activity, as an indicator. Okay, so again, let's take a look here on a shorter term basis and get an idea of what could be, going on here. I'm going to throw on some RSI as well, so we can get a little indicator there too. Okay, your relative strength index. And I'm using a 28 versus the 14, a little smoother, just a personal preference on my part. And then we'll draw the chart up again. Okay, so again, are we going to pop through and go right to 4,800? It's very possible. If we take out 42.18, the recent highs, then obviously that would put into play going up maybe towards 4,800 right away. Conversely, if it starts getting under this number here, which is 46.30, then that and then under 4,600, then that could put into play these numbers down here, which is in the 4,550, 4,500 area. So, the guys that are looking for a correction, like Tom Lee and his buddy, the technician at his firm, they are probably looking at the graph as well. And they're probably thinking, hey, I don't know that we're going to have enough juice to get through this double top. And if we take out 4,630, then a correction from where this thing started in October, and it started in October at 4,300. So it's had a 400-point move. So, moving back into the 4,500 and maybe even into this area here of 4,450 is not out of the question if things were to turn. Hasn't happened yet. So obviously you have got no price evidence of it occurring. But if you did take out 4,660 on the S&P, and if you took out 4,630, then the odds of it occurring would increase dramatically. So that would be our suggestion as far as if you're actually looking for a little proof in the pudding. Today's low also, where this 12 SMA comes in, which is 46.81. Today's low was 46.72. So it got penetrated, but it closed above. Well, if it starts closing underneath that low here of 46.81, that would be your first signal that something could be occurring. Your second signal right here is at 46.23, very close to the low of 46.30. So you got two things right there of which to hang your hat on if you want to stay bullish. And then, of course, if it does break, it could give you a more significant drop. As you saw here, it had a nice significant drop, and then it made new highs. So, it's not illegal for it to have a drop and then go take those highs out by the end of the year. We'll have to see what happens. But again, on a short-term basis, that's what some people are looking for. That gives you a little bit of an idea on that. Growth versus value. A couple of the ones that we look at as a broad-based indicator here is SPYG, because it's a one-stop shop where you get what? You get all those guys that Apple and Amazon, and you get NVIDIA, and you get all kinds of stuff in there, right? All the growth people. And so basically, this is one that seems like it's going pretty good as long as it stays above 71.29. If you want to keep it on a short leash, then it keeps going. Let's see if the RSI has made a new high. The high was here on RSI at around 69, and now the high here is at about 67. So it's really not making a huge new high with the new high in price. But again, this is what growth looks like. Now I'm going to put up value so you can get a comparison. I mean, this thing's gone from 63 up to 72. So since October, this is an ETF. Obviously, individual shares have done even better, but you've almost gone $10 a share on this, which is about almost a 16% jump in about 6 weeks. That's not too shabby. Now, if you look at value, you'll see it has definitely been going at a different pace. This thing has gone from 39 to 41, and it rolled over a little bit here today. So you're talking about maybe a 10% jump here, less maybe about. And so it is definitely being outpaced by value, and that's evidence of that right there. Another one is your tech sector, which gets a lot of your semiconductors in there and stuff like that. And that has been going pretty much just like the growth. It's gone from 145 up to 170. And look at it hold that line. This is what we love about moving averages, right? There you go. You buy it, you leave it alone, your stop's on the other side, you're riding it, you're riding it, you're riding it, you're still in it, never been penetrated. So where is it? It comes in at 167 ballpark. That's where you want this thing to stay above if you want to keep it on a short leash. Okay, so there goes with your growth, and there goes with your tech, and that's why you look into stuff like that. Something that we did suggest, though, this is for longer term thinking. Okay, like I say, if the winds of change do blow, wherein what? That the valuations have just gotten too far, the bottlenecks start solving themselves, the inflation comes down, everything that everybody, and the consumer spends all his money at Christmas time, and he doesn't keep spending after the first of the year. In February, March, could we have a big hit? And if we did get a big hit, where would you want to hide? Well, there's a symbol, not a symbol, but an abbreviation called SHUT, S-H-U-T. In fact, if this starts working, I'm going to be calling it shut up. But here's here's what it stands for. The first thing that it stands for, S-H-U-T. The first thing it stands for is staples. And so on staples, we're going to use a Vanguard one. Obviously, you know, we're just using these as illustrative purposes. But this thing here, you can see, you know, has not gone that far up. If you look at the 5-year graph on it, it has gone up, but it has not gone up like the other stuff. And these tend to pay, see how it's kind of a steadier deal. It's not extended like the tech. It's not extended like the high valuation stuff. You know, so it's a place where people may hide part of their capital, because these are companies, obviously, that are very stable. That's why they're called consumer staples. They're not high valuations. That's why they're called consumer staples, and they pay good dividends. So you get paid money to watch the movie. And that's why this would be something where people might hide out. If in fact they find out that the high flyers are going too far, they sober up on what expected returns are going to be in 2022. So where might they rotate into? S for staples might be one of them. And there you go. So there you can see, you know, it's been trending nice, not very far away from the moving averages. So, and the RSI here is only in the 50s. These other RSIs, you know, are in the 60s and 70s and higher. So this is why this would be something that people may be attracted to if they start thinking the fantastic moves might be slowing in 2022. Again, this is a longer term thought process, something to put in the back of your mind or on a piece of paper and keep an eye on. The H stands for healthcare. And so healthcare is another one that has not been bid up through the ceiling. And here is healthcare. And again, as you can see, steady, 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 was steady before the COVID, and it's been steady after. But it's not way through its all-time highs, and it's not way overvalued in our opinion. As again, these are all our opinions. So again, you know, this is a place where they could rotate into. And again, healthcare is not going anywhere. People get sick, they need healthcare, right? Okay, that's the H. So you got your staples, you got your healthcare. Now let's talk about utilities. Okay, now on utilities, you are looking at XLU. And again, you know, it was steady before the COVID, you know, and it's been steady since COVID. And it's not way away from its averages, and it's not way overbought. Again, these things pay dividends. A lot of the, you know, Pfizer, Merck, these guys pay dividends. In the staples, you know, Procter and Gamble, these kind of people, they Kimberly Clark, they pay dividends. This utility stuff, they pay dividends. Okay, so again, this is the U in your SHUT. And again, this is where people may rotate into, because then they're not buying into way overvalued stocks or high valuation stocks or whatever you want to call them. And they are getting good dividends. So if it does not much for, you know, a while, they at least got cash flow coming to them. All right. And the T would be your telecom. And on telecom, again, that has been kind of out of favor and not doing very good. And so you'll see here is another one, was steady going into the drop, had the big drop. And then it went, and even during the big drop, it only really dropped a lot less than the rest of the market. And now it's been kind of steady, 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 steady up. Now, again, it's hugging on for dear life here. But again, some of these companies, Verizon, AT&T, you know, telecommunication companies and communication companies, they pay dividends. And so that's why, again, we could see a rotation into those type of things next year. And so that's why we would suggest putting that on your calendar. And again, what some people do is they set up a little portfolio within their portfolio, and then they monitor it. And if they can see their one stocks are not doing very well and these stocks are doing better, they can rotate back and forth. So that's the way to do it too, rather than trying to remember. If you have a little bit in there already, you got it on your screen. That's what we like to do anyway. Something that we'd like to maybe take a bigger position in, but maybe right now, sometimes you put a tiny position on so you don't forget about it. That's sometimes a good idea. Okay, so that was just something I wanted to throw out there because, everyone right now at all-time highs, buy more Nvidia, buy more Apple, buy more Home Depot, buy all the all-time highs and just keep buying them. That works out good. And again, it can work out good until it doesn't. And when it stops working out good and the winds of change blow, you got to know where they might be running for cover. And SHUT, in our opinion, might be very well where they run for cover. So keep an eye on that. And I thought that would be worthwhile to provide that information to you. Again, looking at some of the retailers, I was trying to explain to you how Target and Walmart had great earnings, but they had a little bit of a drop afterwards. And as you can see here, it came off of here, now holding right here. And you certainly wouldn't, you want to keep this Walmart if you can above that blue line, which is around 142 ballpark. If it can do that, then maybe this is a good buying opportunity, right? This is on a 5-year graph. If it breaks that, then obviously it becomes more problematic. On a 1-year graph, again, it already has broken, but you can see that this might be, again, it filled the gap, right? Okay, there's another gap down here. I don't know if it's going to go after it or not. Not much of one, but a little bit of one. But right now, if you got above 145 ballpark figure, that would be very constructive here, because then it would be holding that 142 area that we talked about on the 5-year graph. So it's crunch time for Walmart. You don't want this thing trading 140, 135, 136. That would be indicating that maybe something bigger on the horizon's going on. Let's take a look at Target. Our opinion on Target is the reason Target's doing so much better in many respects than Walmart is I think people have more money in their pockets, right? And when they have more money in their pockets, rather than going to Walmart, which is kind of like a place where you get the cheap stuff, maybe you go into Target and stuff has a little bit of a higher end feel to it, a little bit more upscaly. And when people have a little bit more money in their pocket, maybe they don't mind doing that. Plus, these guys have done a fabulous job with online digital. So that's another reason why it did very well. But again, both of those companies are announced that the inflation and the margins and their costs, wages, and stuff like that, it hurt them and people didn't like that. So they sold it off. This thing sold off pretty good from 270 after the announcement all the way down to 250 here almost. So again, it is holding on to dear life here, right around that 250, 248 number on a 5-year graph. Again, it came down and tested. So will it come down and test here? If it does, you're going to come down to 235. If it doesn't, it'll hold where it is now, which is in the ballpark area of 245 to 248, something like that. So that gives you a little bit of perspective there. So, keep an eye on it. And again, you can see the RSI, there's a divergence here. The RSI was 75. That was on that high. Now we got a new high here, but we're not at 75. We are now at 61. That's a pretty good divergence. So I'd be a little bit careful here if it starts breaking underneath 248. Let's see what else is going on as far as some stocks are concerned. Let's take a look, if we could, at another couple of areas that I thought were very close to being on the verge again as well. This is the small caps, and anybody who's been in small caps has waited all year long for the darn thing to break above 230, because look at that range. I mean, this thing started getting in this range. Well, when it entered the range was January of 2021. So that's this year, January. That's when it went into the range. And all year long, it's been going back and forth between 210 and 230. So if you've been in this thing and you bought every time it went up and sold every time it went down, you've been getting chopped up like a salad. But It did break above the 230 mark, and now it came down and it's trying to test it. Today's low is 233. You got all these lines converging here, so you certainly don't want it anywhere underneath the 225 area. That's a great line in the sand. And certainly if you break under 220, it would be, very, very disconcerting. On the 1 year, again, it's that 230 number again, that's where your longer term 36 SMA comes in. It is holding the green, which is at 233. So like I say, if it can hold this 233, that'd be great. 230 to 233 is really where you want this stuff to stop. And then of course, if it gets back above the red, which would be 239, you start seeing 240, then it opens up the door for all this other stuff that you'd like it to go into, but it is in all-time highs. And again, just like everything else, it is very far away from its moving average. So when people start saying there could be a dip, or after January, we could see a correction, this is what they're talking about. This is what they're talking about. And Lord knows where the correction comes from. But again, this is going back 20 years. Do you see anything that looks like that ever before? So, the popularity of investing now, the popularity of opening accounts, the popularity of trading all day long, that doesn't happen at the bottom. That doesn't happen at the bottom. So you got to be careful. But again, you don't fight the tape. So you ride the wave, you enjoy it, you're having a good time, but you're aware that you're pretty far away from land and there's only so much gas on the boat. And that's the whole idea. And if you're going to rotate, the shut stocks might be the ones to rotate into because they're not extended like the ones I'm showing you, right? Okay, next one is in the area of transportation. Again, we were definitely bullish on this stuff on the breakout, but it has pulled back. You see, once it got above 200, that was game on. Pulled back here, 240, not a bad buy spot. Now we got the double top potential. Again, we also have the RSI used to be 66, and now it's at 63, not much of a divergence. But again, this is all the rail companies, the stuff has to get from Long Beach to wherever it's going, right? And it's going to get there by truck and it's going to get there by rail. So that's why this transportation index is interesting. And that's why it's been popping a little bit, because those things have got to occur. So keep an eye on that as a sector as well. Another one that's been coming out, just going over different stocks that we're noticing, Boeing seems to be trying to make a turn down here. Although the long term still looks lousy, the shorter term has tried to turn now. I think once it got above 220, it looked, right above 220, it was on its way. So it's pulling back, it filled the gap. Now it shouldn't be going too much further down. You want to follow the red line, 222 is your number. If you want to follow the green and the other, it's 217, 219. And clearly, if you can get above 235, there's a lot of real estate up here. So, and China was supposedly, going to okay the max over there. That would be a very positive development. Maybe Biden's talking to Xi about that. Who knows? But keep an eye on Boeing. That could turn into something interesting as well. Another one that popped up but then stalled out was Western Digital. See, big pop up and then right back into the soup. So again, this company here, if it can start getting back up, it has a lot of real estate to fill in here. Maybe this is a 1, 2, 3 formation where the one move took you to 62. Then you came back here for about a 50% pullback or so. And now if you take out 62, you could be off to the races. So if this thing doesn't take out the low, which was today at around 54, and it can start taking out 58, then maybe you could use 54 as a get out, and maybe it's going to take an advance at 62. It's certainly not overdone like many of the other stocks are. Okay, I'm going to go around the horn here and give you some ideas on the things that are going on in the different sectors. Interest rates, right? Okay, what do you've got going on interest rates? Let's look at TLT. That's a proxy for the 20-year Treasury. Okay. In March, our position was, this was the temper tantrum. Let me go back to March. See, this was the temper tantrum. That was the end of the spike right there. That's 1.75% on the 10-year ballpark figure. Since then, rates started to drop, right? And then they went back up with yields. Yields went up a little bit. Now they started to drop. Now they came back up a little bit, okay? Right now, this formation could be very easily, there's your low, there's your first move, there's your second. You don't take out this stuff down here. And if we take out 152, the big surprise of 2022 might be that interest rates and yields don't go up, but they actually go down. Wouldn't that be a surprise to a lot of the people on all these financial stations who keep talking about rates have to move higher? Well, if this thing takes out 152, that means yields are definitely dropping, because these things rise when yields drop. So again, if you take out 142 and if you take out this stuff down here, there's no question you'd have to change your tune and become very bearish on the bond market, because who's to say it's going to stop at 2% if it takes out 175? I mean, let's go back 20 years on this thing here, and you can see that who's to say where it would stop if it starts breaking down. If it breaks under where we are now, that's troublesome. If it broke under 135, which is the recent lows, then what is it going to stop? Is it going to stop at 125? Is it going to stop at 115? Or is it going all the way down 85? Well, if the bond market is truly a bubble and they really prick the bubble, do you know how many people are long bonds? You know how much debt there is in the world? If you took all the sovereign debt, the corporate debt, the muni debt, debt on student loans is $1 trillion. So imagine if all those people wanted to dump that debt and turn it into cash because they can see the price of their debt is tanking. Well, then that would be a problem. So that's why the Fed knows that as much as anyone. Do you think they want to see these things break down and end up going into a spike down like these spike ups? Because one thing about a spike down, it's hard to stop. It's hard to stop. So again, yields right now are stable right around that 160 10-year. It's holding the 175 ceiling. And if it breaks underneath 145, which was the recent low, and that's the recent high here, then that opens up a whole different can of worms for 2022. One of where inflation turns into more deflation, where pent-up demand turns into normal demand, where bottlenecks turn into plenty of supply. And that's how the world is. It's round. So sometimes what's happening now is not what's going to be happening in what? In 12 months. And like Red Auerbach said about Larry Bird, 12 months goes by real fast. That's why he drafted Larry Bird as a junior, even though he couldn't play for a year. 12 months go by pretty fast. So, you have to always be thinking about where the puck's going. Okay. All right. So there's your interest rate picture. And again, to give you an idea on valuations, junk bonds have a negative real yield, which means after you get your interest payment on junk bonds, it doesn't even cover inflation. That tells you how ridiculously out of whack interest rates are in the world. So again, also to give you a sidebar, Macy's bonds, to give you an idea how the world is round. A year and a half ago, Macy's, everyone thought was going out of business, right? And their bonds, the junk bonds, were trading 50 cents on the dollar. That means if you bought a $100,000 face, you'd have to put up 50 grand. If you bought $1 million face, you'd have to put up 500 grand. You know what those bonds are going for today? They're going for 100 cents on the dollar, which means your $500,000 would be worth $1 million. And that's a debt instrument where the company owes you your money back, which means you're at the senior level in a liquidation. So that gives you an idea why things can change. And that's why you have to always be aware. And like Larry Summers says about The Economist, you have to be aware of many outcomes, not just one outcome. You have to be at least cognizant of a number of outcomes. All right, so that's your interest rate picture. We'll see how that plays out. With regards to the US dollar, okay, our feeling on the US dollar is that it's up against resistance. Let me get that chart up here for you, because this is a big factor here. And let me see if I can get the proper chart up here for you and see if they'll be nice enough to give me the US dollar index. Let's just see if I go this way. Dollar index. Okay. Now we'll be able to help you with this. I'm going to sprint through the rest of this stuff because we are running short on time. Okay. So on the US dollar index, let's go back one. See if I can get a better read on it. Hold on here. Dollar index. Because I got to have time to go over crypto, gold, and the crude oil and some other stuff too. So I got to get hopping here. Okay, dollar index for December. We'll go to a 20-year graph if they'll give it. Hello, 20-year graph. Okay, yeah. So you can see that the 95, 96 area here is kind of resistance, okay? If we break through here, see, and don't forget, all these lines are still inverted, which means what? That means your 12 SMA is under your what? Your 24 SMA, which is also under your what? Your 36 SMA. So we may be breaking out here. That's why we're saying it's a very critical point. First of all, that blue line has been in force here since 2017. That's a pretty flat line. It's been flat lining on the long-term moving average from 2017 all the way through the present date. That's 4 years. And as you can see, it's kind of a barometer. It gets above the blue line, it comes down. It goes through the blue line, it comes back. It gets back above the blue line, it comes down. Now it's come back. So if we do start closing much above where we are now, you'd have to give credence to the idea that this thing is going to have a rally. Now, our feeling was 94, 96 was resistance, but you know what that means? If we break through that, you got to change your opinion. Now, the RSI here is peaking through 50 at 52. So if you're a dollar index guy, you got to watch very closely, because if this thing starts taking off, it could be back at 100 before you know it. So keep an eye on it. The highs recently look like 96.27. So 96.27, that's your line in the sand. If you start taking that out, you got to get on the long side of this thing, I would think. And then, of course, if it starts fading underneath the number, and the number here comes in at 95 even. So if you start seeing this thing going under 95 and then under 94 and then under 92, then that would open the door to break 90 and come down. So let the market tell you. Above 96.27, you got to go with the flow. Underneath these other numbers, you might want to respect the possibility of this 52 RSI turning under 50 and giving you a correction. Because you can see when the RSI is under 50 all throughout this time frame, you can really decline pretty good. Okay. And of course, when it's above 50 from around right here all the way over, you can go for 5 years on the upside. So this RSI above 50 is quite nice for the market. And if it gets under 50, it would be something to be concerned. It's right on the ledge right now. Okay, international markets. Let's go over those real quick. Our feeling was that we could have seen a low point in the Chinese stocks because they've got the Olympics coming up in February. And our feeling is they want to dust off their suit and put on a very good front for when everybody comes to town. That's why they're trying to get everybody COVID done so they can, take care of these people and all the rest of it. So this is large cap, large cap China. And we saw BABA was disappointed, so it got whacked. And we saw that JD.com and the other ones, Baidu, they are having some troubles. But our feeling right now is possible that right here in October was the low point, and now we've pulled back and filled that gap. So if we can hold this low around 39 and it starts taking out 42, then we think that in December and January, this stuff could be moving to the upside again, because these companies are still making a lot of money, but they've had some problems with regulation, but that could be subsiding a bit. Maybe they've already done that. And they have some sales problems because of, the consumer and all that kind of stuff. But again, this is a very powerful financial machine. And again, I don't think they're going back to Chairman Mao, where everybody is just totally into the communism part of it. So they want these companies to succeed and they want them to flourish. So keep an eye on FXI and see if we're accurate with our low point here. We're still sticking with it so far. And of course, if you're in a bullish situation, dips are for buying, right? Again, this is another one that's, they're both a little bit dicey because, again, the numbers that came out on BABA and some of the other ones was not that great. So this is K-Web. This is your internet. Again, probably would be smart to see if it can break above 53 and 55, because look, there's a lot of real estate. You don't have to be the first guy in. So in this particular case, we would probably wait for momentum so we'd have a crowd behind us. But if it breaks above 53 and 55 in the weeks and months ahead, I would think there could be something there. Okay, so there's your China situation, and that's basically also your emerging market situation. And then you've got Europe, and so we're going to give you Europe here. But again, a lot of people are starting to fade Europe because they're obviously getting involved in COVID again. So again, on a one-year basis, as long as this is VGK, which is ETF for these guys, and then you're looking at as long as it stays above about 68, that's a good thing. And then on a 5-year basis, it's still in an uptrend as long as it stays, and hopefully it'll stay above 68. So the 68 number is very important. You're at 69 and change. This thing starts breaking under 68 and 66. That's not a good sign. Okay, so, and you do have a triple top, but a lot of people say there are no such things as triple tops. So if this thing starts breaking above 70 and 72, then this thing could really have a very bright future. You're very much in a range here. And sometimes when you're in a range, it's better to just do nothing and let the market tell you what to do. And that would be under 66 and 68. That would be telling you to get out. And if it got above 70 and 72, it might be telling you that something's happening. Also, on the European front, some people like the European banks because their valuations are so low. Their price to book is a joke compared to ours. But again, same story. Can it get above this double peak here at around 21 and a half? Probably be a better bargain at 22 than it is now. But the lines come right in at 20. So if you start breaking under 20 and 19, then this thing would be turning down. So keep an eye on the financials, because again, if the future of the European stocks are going to be good, you would imagine the banks would do pretty good as well. And some people do like Deutsche Bank down at these levels. So take a look there. The other thing we like to look at is Korea, Japan, and also Australia. That's called Pacific Rim. And on Pacific Rim, let's see what's going on here. Again, this thing is also on the ledge. You start breaking under 78 with all these averages above, that's not going to be very good. So let's see if it gets above 82 and then 83 and see if it can get going. If it does that, you might have a good shot because it's right at the 50 number on your RSI. So this baby breaks down, no bueno. And if it breaks above 82 and gets going, maybe Japan, Korea, and Australia will get going. All right, what else do we have here for you? Crude oil. We did like crude oil last year. We suggested to people that there's no way minus $37 a barrel is not the bottom. And as you can see, if you bought into XLE when we were talking about it, you've got a double on your money. Now, again, this thing is still in an uptrend. One of the big rig owners, Neighbors, their stock is tanking because they can't make profits with all these rigs. That might be telling us there's not a lot of supply coming. Sure, China could release some stuff and they could back this thing down for a while, but that supply-demand dynamic is going to rear its ugly head again. So again, we're friendly towards energy, but we do think that obviously right now it's stalled out. Again, we'd like to see the oil in the 80 to 85 range on its way to 100. Not under 80. So that's a line in the sand on the crude. But 3 ways to go. This is one right there. Keep it above what? Keep it above, I think it's around 53, 52, something like that. Another way to go is XOP. And this is for your oil and gas exploration guys. And these look good too, as long as we stay above 90 and basically above about 100. And then the last of the batch here is OIH, which is your servicers and all those guys like Schlumberger and, when they go to find some energy. But here, this one doesn't look very good at all. It's starting to crack. So again, you want it back above 203 and you want it really above that high point there. which is around 230. So get above 203 and then above 230, and that opens up the door for all this stuff up here. Right now, it's a little bit on the defensive. RSI right now is at 50, so it's right on the ledge. This thing starts breaking up above 203, 210, it might be onto something. Keep an eye on that. All right, if we turn to the gold and silver, we did think the gold and silver looked pretty good. GDX is something we look at there, but here we're going to look at the exact commodities. Actually, let's see, we got a couple seconds here. Let's throw the crude up there and natural gas. Okay, this is your West Texas for December. Let's see what it looks like technically. Yeah, you know, again, way overdone here on a short-term, on a overbought basis here. On the 5-year graph, you definitely want it to stay above 70. So that's a good line in the sand. On the 1-year graph, I think it might have broken. Yeah, it kind of broke. Now all the averages are coming in right around 82. So getting above 81, 82 is very much necessary if this thing is going to turn around. Your RSI right now is at 51. So crude is at a juncture here. And if China comes out and supplies a bunch of thing out of their surplus and they break this low, it could have a drop. But again, otherwise, if it gets back above these numbers, we'd be much more interested in coming on board. Okay, gold. Okay, December gold. Okay, we have been waiting for gold to break above this 1840 and 1800 mark. You see this here, 18 here, and hold. It has done that so far, but it seems to have had some trouble right around 1875, 1880. Still looks good. Our number in the sand right now is right around the 1820 number. We have a moving average comes in at 1814. Love to see it stay above that. And we'd love to see it stay above the 1800 mark, of course. So there's where our support is. Now, is this thing just a head fake like it was here where it busted up and came down? I don't know. That average is pointing up. And that's a very constructive thing because these are longer term averages that are not going to just roll over. Let's just see on a long-term graph what it looks like. You see, never penetrated that blue line. That blue line is still rising. That's very powerful. These two lines are really where we want it to stay above. And those two lines come in on the long-term graph right there at, let's see, comes in at 1775 and 1804. Those are two very big numbers for gold. If we start closing above the recent high of 1875 and 1880, that bodes very well that this thing could be taking off. Very exciting time for the metals because they are starting to make a turn. We'll know very soon if it's a head fake or not. Silver. And that means your GDXs, your Newmont minings, and all that stuff. One thing that makes me concerned is Newmont mining is awfully low for gold if gold's taking off. Newmont mining is trading 56, 57. The low is 53. It pays about a 4% dividend. Its cost of gold coming out of the ground is very attractive. So the bottom line is that, you know, you'd have to you know, think that it would be way higher if the gold was really going to go. So that has us concerned. Okay, silver, again, trying to break out. We wanted it to close above 25. It did. Now it's back underneath it. I'd like it back above 25 to be constructive on it. But as you can see, you got moving averages coming in here and a lot of support in the area of 22, 23. Okay. Let's take a look at crypto here. GBTC. And on GBTC, which is a proxy for Bitcoin, again, I'll give you the 5-year graph. July is when we told people to get on board. You see this here? If you measure from here to there and take 61% off, you get here. So that's a 61% drop. That's where we said, if you want to buy Bitcoin, that's where you want to buy it. This is all gravy. Don't buy it up here is our view, because when it gets a drop like it's having now, that's when you entertain it again. So if Bitcoin's any good, it's got to stay above 40. Same thing with Ethereum. And then the last thing I was going to show you is for people who wanted to look at exposure in the commodity sector. This is a one-stop shop over at Vanguard. Get the prospectus, get the details, and see if it's for you. But look at this in the last 5 years, and it's not, hasn't been around a whole 5 years. It started out in March of 20s, kind of. And as you can see, it gave you the buy signal on the, this is a commodity strategy fund. So that's why you got to get the prospectus, understand it, talk to your broker, talk to your advisor, everybody, and see if it's right for you. But for people who want to get exposure on a one-stop shop, this has not been a bad place, because just this year alone, we started the year at about 27 bucks. And it hit recently 37 bucks. So, 10 divided into 27, that gives you a pretty good size move of about 37% in this particular asset. And again, as a diversification for people who think commodity inflation may be with us for a long time, this is a one-stop shop where, again, you're not trading options or margin or all these other kind of things you can do, day trading and all the rest of it. This is a way you can do something different. So,
hey Jim, we're about out of time.
I'm wrapping up right now. Okay, guys, it's coming to the top of the hour, so I did want to let you know how to contact us if you have any questions. We're obviously very knowledgeable on a lot of different areas. Again, this is our opinion and our observation. So just go to the website and put your email in, optionprofessor.com, OPTION, professor.com. We'll send you a newsletter every week updating our views on all this stuff. And if you want to contact us with questions, it's optionprofessor@gmail.com. Send your questions and your contact information. You can talk to us directly. Okay, thanks for being here, you guys. I hope you learned a lot this week with all the shows, and I'm going to send it back to David.